everything's heating up. Dollar volatility heating up as well. Quick little overview from some number crunching I did. If we go straight to the first slide, we can see exactly what I'm talking about. This FX volatility heating up, hitting fresh highs. And this is monthly numbers, right? So just came in numbers from February, and we're ticking upwards in a pretty positive direction. And if you're looking all the way to the left of that graph, wow, that's a big month. That was, of course, the Liberation Day shakeout, April 2025. And so that, if you're contextualizing, was a very elastic time for FX markets, all markets, really. And so now we're at a pretty elevated level, but I will also say that December we had in 2025 was historically very low for these dollar markets. And it kind of fits in with the narrative that, of course, this administration has been a lot more prone to volatility, but we're still in the equity space, very close to all-time highs. And while there's so much action there, you tend to see a little bit less volatility in the currency space if there's less demand for U.S. dollar. U.S. dollar is such a driver in the global landscape for FX markets. So it's no surprise that while a lot of other asset classes, more speculative asset classes, are interesting, that this volatility dips to as low as it has. But this means a lot of different things. So this is kind of the zoomed out view, but want to dive into which pairs are moving the most on the next slide, which gives us a more granular view of things. And this is, what you might expect, but if you aren't tracking individual dollar pairs as closely, this reveals, the very current trends that we've seen not only over the past, couple days, but couple months now, where you're getting the Australian dollar with its correlation to not only U.S. equities, risk sentiment, and metals exposure. That one's been whipping around. And then we have our yen pairs, not only the US dollar, Japanese yen, but pound yen and euro yen, very liquid pairs to trade. Those as well, very volatile as of late with the Japanese new administration and their policy and politics starting to really move that yen that's been pressed at historic lows recently, not only on one occasion, right, since the latter half of last year. I think 3 times we've been pressed into, really extreme territory, 30-year lows for that currency. But bouncing off of it, and when it does to a pretty violent degree, as we saw earlier in January, a 3-day shakeout of around 3%. So those are the markets moving the most. Interesting point to call out that this pound dollar has been moving a little bit more than the euro dollar as of late, but both in the same ballpark. And that gets you to the lower end of the range, where you see, not surprising, two very highly correlated currencies in the euro and the pound due to their geographic proximity and economic ties. No surprise that that's a lower volatility option. And U.S. dollar, Canadian dollar, similar dynamic, actually, when you think about geographic proximity. But that one, lower volatility lately, less, the eye of Trump, less fixated on tariffs in Canada. And with these recent geopolitical conflicts, very removed geographically Canada is. And even though historically you might think Canadian dollar tied to oil prices just because of the percentage of their GDP that relies on oil exports, this recent conflict hasn't really sparked that correlation in a positive way, just because the actual play out, right, isn't purely in price action for oil, but more so about the trickle down effects into what it means for energy prices in the regions more specifically. So that's why you're seeing even that euro dollar move more from the recent headlines than this Canadian dollar. Does anything surprise you from this breakdown?
You?
The pound dollar is interesting. I don't think I've traded that all too recently.
I
Yes.
just did yesterday.
So that one's a pretty interesting one when you're comparing pound dollar and euro dollar for retail traders like us, because you're getting a pretty high correlation between the two. You have seen recently some idiosyncratic risks to the British pound, where you are getting headlines from the UK government, from their their economic landscape, that's caused some more sensitivity there around budget spending and whatnot. But from a tradable aspect for retail traders here in the U.S., it's important to note that the margin requirement currently for British pound US dollar is held at 5%, whereas the euro dollar is still at 2%. And so if you're actively trading these markets, while the British pound might be slightly more volatile, the actual exposure you could get if you were leveraging up to near max, you can capitalize potentially on a lot more moves in that euro dollar, just because of how the retail landscape is currently for U.S. clients. Similar dynamic with the yen, but that difference makes it a more tradable asset. But that one, because of its historic volatility, also held at a higher rate at 5%. Just on
Does anything surprise me? I would say no. Mostly because, look, I like times like this, and by that I don't necessarily mean like volatility, but truthfully, when it happens, you get to things make more sense, I would say. I mean, there's times where, like, absent of this situation, these things are kind of moving independently. Like you said, a lot of it is based off of policy, and you just can't necessarily depend on what direction things are going to go because of the crazy outperformance by the dollar. You kind of knew exactly what was going to happen, and there was nothing left to the imagination. They made the moves that they made on purpose. And so as a result, like I said yesterday, I mean, I still have a couple of long dollar trades, but two trades in particular that I decided to go short dollar, and we're getting long the euro dollar and long pound dollar. And I only got long like 2 micro lots of pound dollar. But yeah, for that reason, because of the moves that happened, I decided to do that.
Yeah, absolutely. And what I like about this landscape here with dollar volatility picking up, especially how it has, is you're still getting a wide range of movements. You have this euro pound, which has been kept pretty muted because, as I've done on some other strategy analyses, lower volatility markets can behave differently, may favor mean reversion more than trend following. So still a wide selection of potential opportunities out there, and pairs to select from. But just want to wrap it up on the last slide, what this means for traders. A lot of things to consider, but recognizing that it is perhaps a changing environment is the first step, and especially coming off of such muted levels, where you would have to, for certain strategies, really tighten up your profit expectations and your potential stop losses. Widening your levels might be something necessary to consider, especially on potential stop losses. This morning's movements across asset classes, especially around the U.S. Open, right? We've seen a few head fakes, which could leave you out of the bigger move, even if you end up being directionally right on the day. Tight stop losses might get dinged during more volatile environments, and you're not able to hold that position. Shortening your time frame, I think, is an interesting one, and kind of speaks to what I was saying earlier about considering staying flat and being more reactive. Just because different strategies work for different time horizons and different people. It's all about finding what works for you. But if you are looking for mean reversion in more volatile environments, you might only get a pullback as you expect, and be right away. But trying to hold on for too long, you might be fighting the trend over a longer term horizon. So important to take profits perhaps while you have them, and then sizing down. You guys are familiar with this, no strangers to the tasty mentality of staying small, but it's especially in your portfolio, Mike, just what you've seen, being able to weather the storm and not be out of the game completely keeps you sustainable more than anything else. These are leveraged products that can be that can get out of control pretty quickly, but keeping your trade size small and even respecting a higher volatility environment by lowering your average trade size, even if it is something you are familiar with. If these markets start moving twice as much as they have been over the past few months, then for your trade setups, for your personal analysis, might get very different if you don't size down. So that's what I got for you on respecting the volatility environment
Well said.
FX markets are currently in.